With the global shutdown still unfolding and civil unrest, the economy of the United States has seen better days. The stock market, on the other hand, is almost at the same levels it was 10 months ago. The economy is nowhere near the same as it was 10 months ago. I think we could all agree on that. In this video, we are going to take a look at why the stock market is so high, what alarming things companies are doing that might signal a downturn, and what the future of stocks might look like. Before we begin, don't forget to like and subscribe to see more videos. In May, companies sold more than $60 billion in shares. This was the biggest amount ever, as the stock market continues to rally. A company sells shares of their own company to be able to generate some quick capital. Companies tend to do this if they think their stock price is higher than it's actually worth. If they can sell their shares now and wait for a downturn and buy them back, why wouldn't they? That's like when people were going crazy for hand sanitizer. You started to see prices skyrocket because everyone wanted the hand sanitizer. People began selling all the hand sanitizer that they had because the prices were just too good to pass up. This is basically the same thing. A lot of people are jumping into stocks right now because they're scared they're going to miss the wave back up. Companies, on the other hand, are selling shares because people are buying at high prices and they believe that there will be a downturn eventually. A great example of this is when Tesla was around $900. They issued new stock to be able to capitalize on the high prices to bring in more money for the future. Inevitably, the stock price dropped back down, and it was a smart move on Tesla's part to secure additional funding. This is a telling outlook, as companies themselves are starting to think that their own stock prices are too high and are beginning to lock in some profits just in case another downturn does occur. Companies are valuing more cash at a time like this, since the future of the economy and people's financial situations are uncertain. They want the extra cash so they can weather a long economic rut. A survey done by CNBC saw that 51% of CFOs believe that the Dow will fall back below 19,000 before we reach another new high. Only 22% of CFOs that were surveyed expect the Dow to reach new record highs without taking another major decline. Many believe the recent stock market rally doesn't affect economic reality. This is true, but you always have to remember that the stock market isn't a sign of how an economy is doing. There's also no rational way that our economy is as healthy as it was 10 months ago. You also have to note that many of these stock market indices, such as the Dow and the S&P 500, are weighted by total market cap of each company. Many technology companies such as Amazon, Microsoft, and Apple have huge market caps compared to other companies in the indices. These companies have been on a huge rally since they were not hit as hard from the lockdowns. This is where a majority of the stock market rally is coming from. Another tell of a possible bad economy is that Wells Fargo has stopped making loans to independent car dealerships. They are doing this because they are worried about defaults on these loans. Independent car dealerships tend to sell a high number of used cars to subprime lenders. Usually it is much easier to qualify for a loan on a used car than it is on a new one. You need around a 700 credit score to get financing for a new car, but only need around a 600 credit score for a used one. Before the pandemic, Wells Fargo was actually growing its auto lending business. Auto loans at Wells Fargo rose 19% in the first quarter to $6.5 billion. Delinquency rates on subprime auto loans have already hit an all-time high this quarter, with $68 billion worth of auto loans already 90 days late. Ally Bank said that around 25% of their auto loan borrowers had already asked for deferral payments, and 18% have already enrolled in deferral programs by the end of March. However, delinquency rates for prime borrowers remain at record lows, so this is a sign that banks are tightening up their requirements to borrow money. This means that they aren't so sure about the economic outlook and aren't willing to take on riskier borrowers that are more likely to default on their loans. Also, with the Hertz bankruptcy possibly flooding the used car market, lowering the price on all other used cars, many people are underwater on their cars. So even if the bank takes the car back to resell, they will not be able to recoup their initial loan amount. I go more in depth on Hertz and the used car market in my Hertz bankruptcy video. One shocking thing is that home prices in April saw its biggest gain in 2 years. This makes sense though, since there aren't a lot of houses being put up for sale at the moment. This is creating a scarcity in home inventory, and the homes that are for sale are going for higher prices. Many people are waiting to put their homes up for sale as they are hunkering down because of the pandemic. Also, interest rates are near zero, and when interest rates go down, home prices go up. This is because it's cheaper to borrow money. Home prices tend to lag behind other investments, such as stocks, because it takes a lot longer to buy a home than it does a stock. A lot of the data that is coming out on home prices is actually homes being bought back in the beginning of the year before the pandemic hit its peak. This means that we might start seeing home prices come down as sales from May and June come in. As things begin to open back up, people's jobs might not actually be coming back, and this might force them to sell their home as they can no longer afford it. This will decrease home values as many people will be forced to get rid of their homes quickly, even if it means selling it for less than they anticipated. Many people are also leaving cities as they are scared for another wave of illness. Cities also tend to be more expensive to live in, and if a lot of jobs don't come back, people can't afford the higher cost of living. People are more inclined to work remotely now, and this will also lead to people leaving cities, as they can live for less elsewhere. As people leave, real estate prices will begin to fall, as there is less demand in those areas. However, prices will begin to rise in the other areas where people are moving to, as the demand picks up in those areas. So real estate prices are probably going to look fairly flat, or even rise depending on the area. At the end of the day, nobody truly knows what the price of stocks, real estate, or any other type of investment is going to be. The only thing you can control is how much you spend, and to invest consistently and hold for a long term, and you will come out ahead. It is also good to have multiple sources of income. If one stops, you can lean on the others to get by. And with that being said, as always, thanks for watching, and if you enjoyed the video, like and subscribe to see more.